Good morning, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. We all know that Bitcoin is the only collateral with mathematically enforced scarcity, full global liquidity, and zero reliance on any political discretion. And this is kind of important for Michael Saylor and strategy because this will enable them to eat entire industries. Every other asset that is used as collateral depends on external governance, human trust, or inflationary policies, but Bitcoin depends on a rule set that cannot be altered, and this creates a structural advantage that compounds as adoption of the asset increases. So let me be precise with what this means in practice. We all know that gold requires armed guards, vaults, assayers, transport infrastructure, etc. Real estate requires legal systems, property registries, maintenance, geographic constraint. Sovereign bonds require faith in fiscal policy, central bank competence, political stability. We all know that these things are not guaranteed, and for the love of God, when we talk about corporate bonds, good heavens, corporate bonds require faith in management. They require competitive dynamics, accounting integrity. All of these things obviously never guaranteed. So what I'm trying to say is that every traditional form of collateral carries immense amounts of operational overhead, counterparty dependency, and dilution risk. Bitcoin carries none of these burdens at all. Supply is capped at 21 million units of cryptographic consensus that would require breaking the foundation of modern computing to ever alter. The custody requires only private keys, as you know. The verification requires only internet network connectivity. The transfer requires no intermediary approval. The authenticity is provable by anyone with an internet connection within seconds. So this is not merely superior collateral, kids. Bitcoin is the collateral that exists in a different category of reliability altogether. When one corporation accumulates more of this asset than any other entity on Earth, it controls the most secure and the most desirable collateral base available to the global credit markets. And once the market discovers this superior source of collateral, it will gradually migrate toward that source. It is inevitable. It has to, because this is literally how systems adapt. We all know that liquidity in the system seeks arrangement with the highest safety, the lowest risk, and the strongest yield characteristics. And we are seeing all three of those things with the strategy preferreds. Saylor positions strategy exactly where that convergence is going to occur, and it is going to be a beautiful thing to see, and the people that see this will reap the rewards. Obviously, MSTR is a very polarizing stock, but I just gotta say, remember this: if everything was consensus, well, your opportunity would not exist. So I believe that Saylor and strategy are going to eat entire industries. This will be the most valuable company in the world, and I am going to go over a precise analysis of why this makes perfect sense, and it's not hopium in the slightest. Number one, collateral quality determines the cost of capital. Collateral strength directly influences the interest rate that an issuer can command, and we all know that weak collateral forces higher yields because the lenders take higher risk. Therefore, they look for higher yields to compensate for that risk. The strong collateral, though, that compresses yields because the lenders face less risk. And Bitcoin obviously represents the strongest possible collateral profile for those reasons that I just mentioned. It cannot be arbitrarily increased in terms of the supply. It has no counterparty obligations. It can settle anywhere on Earth within minutes. It's liquid across every major market 24 hours a day, and it exhibits historically unmatched long-term capital appreciation. When it comes to liquidity, what would you do if real estate was your collateral? How do you liquidate $1 billion worth of real estate? How do you liquidate immediately $1 billion worth of gold compared to Bitcoin? So it has the liquidity benefit, it has zero physical risk, and on top of that, it appreciates better than any other asset ever since it's been around. These properties of Bitcoin, they reduce risk so much for lenders to a level that no fiat-based collateral can ever match, and the result is a naturally lower cost of capital for the issuer who holds the largest supply, which is obviously Michael Saylor and strategy, and that issuer becomes the cheapest source of high-quality credit in the entire world economy. Consider the mechanics more deeply, perhaps. When a lender evaluates collateral, they perform risk analysis across multiple dimensions. I just kind of mentioned them. There's liquidity risk, there's counterparty risk, there's custody risk, verification risk, volatility risk, and dilution risk. And traditional collateral fails on multiple of those dimensions simultaneously. You think of a treasury bond, okay? A US government treasury note. It might be liquid, but it suffers guaranteed dilution through monetary expansion of the currency. We all know this. And we know that real estate is tangible, but it suffers liquidity constraints as well as geographic concentration risk. Corporate bonds offer yields, but they carry management risk and business cycle exposure, and gold is scarce, kind of. But the custody of gold is very expensive and verification is cumbersome. Just ask Peter Schiff when he couldn't tell if he was holding real gold. We know that equities appreciate absolutely, but they dilute through share issuance potentially, and then they suffer through earnings volatility. So Bitcoin is the first asset in human history that scores optimally across every single dimension except short-term price volatility if you're denominating it in something that is volatile. And even that one characteristic actually diminishes over time as adoption increases and the market depth starts to expand. So volatility will compress through scale because it has to, and Bitcoin will become the Pareto principle optimal collateral, the single asset that dominates all others in the world across all relevant risk dimensions. And for some reason, not every company in the world is scrambling right now to secure this advantage. But Strategy has done that, and they are compounding faster than any competitor. The company that compounds fastest eventually swallows market share across sectors because no competitor can finance their expansion as cheaply or as safely. And this is why accumulation of the pristine collateral of Bitcoin is a structural advantage in capital formation. The market is going to reward the issuer with the best collateral because it minimizes uncertainty and maximizes predictability. Strategy has obviously positioned itself as that issuer. Nobody comes even close, but the implications go deeper still. The company with the lowest cost of capital can outbid competitors for acquisitions. They can underprice competitors in product markets. They can outinvest competitors in research and developments. They can outlast competitors in downturns. The reality is this: the people who buy the most Bitcoin buy the most optionality. And this advantage is not limited to financing. It extends to every domain where capital is the constraint. And fun fact for you, in modern economies, capital is always the constraint. We know that the conventional credit markets out there, they suffer from two structural problems. Number one is time-based risk due to the maturity structure of bonds, and number two is purchasing power erosion due to inflation. No treasury bond can avoid these problems because the currency backing the instrument is inflationary by design, and Bitcoin obviously just totally avoids that problem entirely because it has no maturity. It has no dilution mechanism, and this will allow for perpetual preferred instruments that offer stable yield without locking creditors into long duration exposure or exposing them to currency debasement. And the reason why this matters so profoundly is because traditional fixed income forces investors into an impossible trade-off. To capture yield, they must accept duration risk, the risk that interest rates rise and the present value of their bond declines. And to avoid duration risk, they must obviously accept rollover risk, the risk that they cannot reinvest at attractive rates when their bond matures. And regardless of which risk that they accept, they cannot escape the debasement risk of the currency, the certainty that the purchasing power of the US dollar or the Japanese yen of their principal erodes through that monetary expansion of their currency. And this isn't a theoretical problem, kids. This is literally the central problem that is running rampant across all societies. Every single institutional allocator on earth is running into this problem. You think of the funds out there that need long duration assets to match long duration liabilities like pension funds. The thing is that long duration bonds lock them into low nominal yields and guaranteed real losses. Insurance companies require stable cash flows to fund their claims, but remember, the stable cash flows denominated in a depreciating currency become progressively inadequate over time. And sovereign wealth funds, they require preservation of purchasing power power across entire generations, but every single fiat instrument that's available to them guarantees slow confiscation of purchasing power through inflation. The Bitcoin-backed preferreds that Michael Saylor has come to market with, Strife, Strike, Stride, Stretch, and Stream, they all solve this trilemma that these investors encounter because they offer yield without maturity, they offer safety without a lot of counterparty risk, and purchasing power protection without commodity storage costs. The yield on these things outruns inflation. So any investor who purchases a perpetual preferred backed by Bitcoin, they receive stable distributions denominated in fiat while holding that indirect exposure to an asset that appreciates against fiat over time. And the instrument is perpetual. It does not mature. There is no duration risk in the slightest. The collateral backing the product itself doesn't dilute, so there's no debasement risk, and the settlement is cryptographic, so there is no custody risk. The ability to issue perpetual credit instruments that are backed by Bitcoin, it creates a superior financing tool that nobody in the world can even touch. Corporations start to gain access to capital without facing refinancing walls, and investors gain access to yield that is protected from inflation. And this is just going to change how all of the treasury allocators allocate capital throughout the entire world. And once corporate finance teams start to understand this advantage, they're going to have a fiduciary obligation to explore them, obviously, for all of their shareholders. But the obligation, of course, goes beyond exploration. Once a CFO understands that a competitor can finance operations at 3% using Bitcoin-backed instruments while they are paying 6% through traditional debt, that CFO faces a career-ending decision. Adopt the new structure or watch their company become structurally uncompetitive. The board will not tolerate the latter. Shareholders will not tolerate the latter. The market will not tolerate the latter. And this competitive pressure forces widespread adoption because any capital that fails to integrate these bit-backed credit structures will operate with inferior capital efficiency compared to the competitors who adopt them. And over time, this gap is going to grow and it will become tremendous. It will become very obvious that the structural benefit compounds into absolute market dominance. And fun fact for you, I'm not speculating in the slightest. This is literally the same process that drove every single major financial innovation in the history of the world. We're talking letters of credit, joint stock companies, commercial paper markets, securitization. The innovation that reduces cost and risk wins. The laggards will lose market share until they adapt or disappear. The largest capital pools on earth belong to insurance companies, these pension funds, the sovereign wealth funds, the endowments out there, the banks, large real estate lenders, etc. These institutions hold trillions upon trillions of dollars in fixed income assets that yield far below the rate of monetary expansion. And this condition forces them into this perpetual search for higher yield that does not compromise safety. And Bitcoin-backed preferred instruments provide exactly what these institutions have lacked because they give higher yields than bonds, they give higher safety than corporate credits, they give protection against inflation and liquid collateral that is observable and auditable in real time. These institutions have to discover that a new asset class is being born and they're providing better real returns with a lower structural risk. They will begin to allocate once they understand this. They will have no choice because underperformance creates regulatory problems, it'll create problems for the shareholders, and it will create political liability. Let me walk through the logic facing some pension fund manager, okay, that they oversee obligations that extend decades into the future, so they must generate returns sufficient to meet those obligations without taking excessive risk. For the past 40 years, they accomplished this through a 60-40 portfolio of stocks and bonds, but we all know that that model is totally broken because bond yields are structurally inefficient. A 10-year treasury yielding 4% cannot fund liabilities growing at 7% due to cost of living adjustments in an inflationary society. The gap has to be filled through riskier allocations, high yield credit, private equity, real estate, infrastructure, etc., etc. Each of these allocations increase complexity, they reduce liquidity, and introduce a new form of risk. So this pension fund would become a Baroque structure of overlapping strategies, none of which solve the fundamental problem that the yield required to meet the obligations exceeds the yield available from safe assets that are out there. With Bitcoin-backed preferreds, the structure is simpler, it's more liquid, it's more transparent, and it has better appreciation. It solves the problem that has plagued institutional allocators since interest rates fell below the rate of liability growth. The capital rotation to Bitcoin through these avenues is literally just going to be dictated by reality that the underperforming capital must migrate to superior instruments. This is literally how entire industries transition simultaneously. None of them can defend their old models. Once a superior structure opens the market, in a marketplace, the best product always wins. That's just reality. The shift might be slow at first, but then it will be irreversible. First institutions to adopt capture the best terms. Obviously, there will be the secondary, the tertiary institutions that will be waiting. They will face deteriorating terms as the supply of Bitcoin tightens. The institutions that resist watch their competitors outperform until the boards intervene. The progression is very predictable because it has happened countless times before. When equities replace land as the dominant form of wealth, when bonds replaced gold as the dominant form of savings, and when dollars replaced sterling as the dominant reserve currency. The asset with the best properties wins. The institutions who adopt earliest win. The entities that control the supply win most of all, and that is strategy. Pristine collateral creates a monopoly on high-quality credit. When a single entity controls the largest supply of pristine collateral, that entity becomes the anchor of a new credit system. Strategy will become the lowest risk borrower and the most desirable lender. It becomes the template for global balance sheet optimization. The other issuers out there will begin to adopt the same balance sheet model. We have seen that, Metaplanet, for example, but none of them will ever match the scale or the purity of the original collateral holder. This will entrench strategy as the benchmark for Bitcoin-backed credit markets. Nobody will ever catch Saylor. Everybody is just building the staircase beneath him at this point. And we all know that once an entity becomes the benchmark, that just means that every other issuer out there is measured relative to its model. And this locks in a very durable advantage that begins to spill over into banking, insurance, pensions, these sovereign credit structures, corporate treasuries, etc. The issuer of the pristine collateral instruments will effectively set the standard for the entire industry. But we must understand what a benchmark means in practice. I'm not talking about just a reference point. I'm talking about a gravitational center where all the other actors have to orbit. When strategy issues a Bitcoin-backed preferred at, let's say, 8%, that becomes the floor for all other issuers. The smaller holders have to pay 8.5% or 9% because their collateral base is weaker and their scale is smaller. And this spread is going to create a permanent financing advantage that compounds with every single capital raise. And this dynamic obviously just resembles the emergence of the US Treasury market as the global benchmark for sovereign debt. Once the Treasury became the deepest, the most liquid, the most trusted sovereign credit instrument, every other sovereign bond was priced as treasuries plus a spread. That spread reflected the additional risk of lending to a government with less credibility, less liquidity, or less stability. The United States has obviously just captured a structural advantage. It could borrow at the lowest cost because it set the standard, and the same thing will happen with strategy. The first mover captures the collateral. The collateral enables the cheapest credit. The cheapest credit enables the fastest growth, and the fastest growth enables more collateral accumulation. This cycle will repeat until the first mover becomes structurally unreachable by any competitor. Control of pristine collateral gives a company control over the most desirable form of financing, and finance obviously dictates growth, and growth dictates market share. And spoiler alert, market share dictates who defines the rules of capital allocation. The progression is very simple and it's inevitable. So industry by industry, the same pattern is going to unfold. Number one, banks are going to lose their monopoly on credit creation, and it will be a glorious thing. Number two, insurers will rotate reserves to higher yielding Bitcoin credit. Number three, the pensions will migrate to structurally superior yield. Number four, endowments will obviously adopt the best risk-adjusted profile. Number five, real estate lenders will reprice their entire capital stack. Number six, sovereign governments will begin exploring Bitcoin reserve bonds. And number 7, the corporate treasurers will replace traditional debt with perpetual preferreds. All of these outcomes flow from one fact: a single company holds the most concentrated supply of the highest quality collateral the world has ever seen. Once that fact becomes widely recognized, capital allocation across industries will continue to shift toward the entity that is holding that collateral. And this strategy isn't dependent on salesmanship or marketing either. It is a strategy that is dictated by objective collateral superiority. But let me trace the mechanism more precisely. This amazing capital migration to Bitcoin is going to force a repricing cascade, and strategy is leading the way. Bonds are going to get repriced relative to Bitcoin. Real estate collateral will be repriced relative to Bitcoin. Corporate credit spreads will adjust to Bitcoin-based benchmarks. Sovereign creditworthiness is going to be evaluated against reserves of Bitcoin that other entities have, and equity evaluations will eventually adjust to capital structures that are built on pristine collateral. But that repricing has not happened yet, and in my humble opinion, therein lies the opportunity. I want to be very clear about the magnitude of what this means. I am not discussing some rotation within existing asset classes. I am discussing a revaluation of the entire financial system relative to the new measuring stick. Because remember, when gold became the new monetary standard, all prices were expressed in gold terms. When dollars replaced gold, all prices shifted to dollar terms. The transition from gold to dollars took decades and involved geopolitical upheaval, world wars, and the reconstruction of international trade. The transition from dollars to Bitcoin will be faster because information travels faster, capital is more mobile, and the superiority of Bitcoin as collateral is mathematically demonstrable rather than politically negotiated. And this is why every single asset will be measured against Bitcoin, not just financial assets. I'm talking every asset: real estate, commodities, art, intellectual property, corporate equity, sovereign bonds, private credit, infrastructure, farmland. All of it gets repriced relative to the new standard. And when repricing occurs, relative values shift. Assets that are scarce, liquid, and free from counterparty risk appreciate relative to assets that are abundant, illiquid, or dependent on trust. Bitcoin is the most scarce, it's the most liquid, and it's the most trustless asset in existence, and therefore it sits at the apex of the new valuation hierarchy. The entity holding the largest supply of the apex asset becomes the wealthiest entity in the system, not because it extracted wealth from others, but because the system reorganized around the asset that it accumulated. This is not exploitation. This is not theft. Bitcoin isn't captured. This is the natural consequence of identifying superior collateral before the rest of the market understood what it was witnessing. Now extend this logic to entire economies. The nations that accumulate Bitcoin reserves will improve their creditworthiness, reduce their borrowing costs, and attract more capital as well. The nations that resist Bitcoin accumulation will watch their currency depreciate, they will watch their borrowing costs rise, and they will watch their capital flee. The divergence will compound over time until the Bitcoin accumulating nations will dominate global finance the way that dollar-holding nations dominated finance in the 20th century. And who advises those nations? Who provides the blueprint for Bitcoin reserve management? Who holds the collateral base necessary to backstop sovereign Bitcoin bonds? Strategy. And not through conquest, through collateral superiority. The implications of this are profound. We are still early, but this is why strategy will be the most valuable company in the entire world, and why Michael Saylor and strategy will eat entire industries. My name is Adam Livingston. I am the Bitcoin Wizard. If you like this content, please like this video and subscribe to my channel. I am on the front lines spreading the orange gospel of Bitcoin every single day, and I need your help. Liking the video will really help the algorithm, so please do that, as well as leaving a comment below with what content you want to hear next. Have a terrific day. Do not party too hard. Class dismissed.